Hello, with me today I have Thomas McMahon, Investment Trust Research Manager at Kepler Trust Intelligence. Hi Thomas.
Hi Lee.
Good to see you again. Thomas, for those of us who want to invest for income over the next 12 months, which investment trusts do you think we should all be looking at?
Well, I think the pandemic period has really highlighted the strengths of investment trusts for income, and that's reflected in relatively narrow discounts in the UK equity income sector. I think of the equity income trusts, City of London really stands out as having absolutely rock solid revenue reserves and just continues to generate good income, and as at the time we're speaking, the dividend yields around 5% or so, and it's done that year after year after year, and has performed very well on a total return basis this year in 2022 too. I think if you're looking for higher income, there are some. You can take a bit more risk in equities, and CT UK CT UK High Income stands out. It's got a bit of an innovative structure that allows the ordinary shareholders to receive an elevated dividend, some capital growth shares that don't. So, I think there's a couple of examples, but frankly, the sector as a whole looks very interesting in terms of dependable income. I guess the question for investors is whether it's enough pick up over cash. So that depends a lot on what we see in the rates, in interest rates over the coming years. But I guess with equity income, you always have to bear in mind that you've got the dividend growth prospects. So as the kind of UK facing businesses in the 250 and so on have taken a significant hit. So the FTSE All Share has done relatively well this year, but the 250 is down, the small caps are down. There's a potential for earnings growth and income growth over the long run, which maybe makes equity income an interesting place to look. I think, alternatively, you can get a higher yield. The question at the moment is people are a little bit concerned about valuations and whether the NAVs fully reflect recent interest rate increases. So, but from an income perspective, that may not matter if you're holding for the long run, and then you can get a much higher yield. I think something that looks quite interesting to me at the moment, it's a trust called M&G Credit Income. So this largely invests in floating rate loans and bonds, which means that the coupons it receives increase as interest rates increase. And so what that means is that the current historic yield understates, in my view, what the income is going to be, particularly as in this trust will pay a larger dividend at the end of the financial year based on what's happened over the year. So I think at the time it's yielding in the fours, but I would expect that you would get a higher yield than that from something that should be relatively defensive. So it doesn't have a lot of interest rate exposure at all. It does have some credit exposure, so it's not riskless. But I think it's another interesting place to look for income.
So Thomas, after a big stock market correction in 2022, plenty of investment trusts are trading on significant discounts to net asset value. Are there any heavily discounted sectors or individual trusts that catch your eye?
I think that discounts have largely been relatively rational so far. So the things that have moved on to the biggest discounts have been the things that have the greatest rate sensitivity, the greatest duration, and the greatest gearing. So that would be property, real assets, growth stocks. I think things that stand out as looking a little bit overdone would be private equity. So private equity is a bit of a complex area, a bit illiquid, it uses gearing. So the trusts do tend to have a reasonable discount, and they have done for quite some time. It doesn't really seem reasonable in the good times. But over the last year, those discounts have moved out to say 35 or 40% in many cases, and that just seems a bit too much. So it's quite likely that we'll see valuation declines reported in the coming quarters, but that seems like a pretty substantial cushion. So that's an area of interest. But I do think investors need to, in particular, dig into the gearing situation with those trusts to make sure they fully understand that before investing. But I think that's an area that does look pretty interesting. Beyond that, in the more conventional sectors, the discounts aren't extreme at the moment, but UK small caps on 10 to 15% or so. They've been wider during the year, but I still think this is a very good long-term growth market, and that's quite a nice extra return if you've got a long enough holding period. So that's an area I think that's quite interesting.
Are there any trusts in that sector that stand out for you?
Discount wise, I mean, it'll move around day to day, but for a value focused investor, Aberforth is trading on a double digit discount at the time we're speaking, so that's quite interesting. Growth investing, BlackRock, smaller companies, also trading on a significant discount. I mean, I think there's a lot of quality portfolios in that sector, and most of them are on wide discounts. And I think that sector has a track record of the discounts narrowing when times are good. So it may not come for some time, but if you've got a long-term perspective, that could be quite interesting.
Thomas McMahon, Investment Trust Research Manager at Kepler Trust Intelligence. Thank you very much for joining me today.
Pleasure.